All right. Hey, everyone. Mark Rusin here, and welcome to the Dividend Power Hour. This is our third session that we've already done. I can't believe it. If you are listening live, welcome. If you're watching the replay, welcome as well. But if you are watching this live, I want to hear where are you guys watching from. If this is your first time to the channel, my name is Mark Rusin. I'm a CPA here in the state of California. It's actually a nice, feels a little bit like summer today. It's here in Southern California. It is low 70s, so can't complain about that. So in the chat, I want to hear where you guys are watching from. Then let me know what's the temperature outside. Are we getting closer to summer where you're living or not yet? Peter, I see you in there. Matthew, awesome. Thank you guys for joining. And we will be, it'll be a little bit different. The first two, we looked at a lot of different earnings for different dividend companies. Today, we're going to talk recession talk and take a closer look at the economy as well. So El Tran from Florida, Matthew from St. Louis, awesome, nice. So it's probably getting a little bit cooler out there since I'm on the West Coast. It's only 4 o'clock here, 7 o'clock back where you guys are in Florida, and then St. Louis. Awesome. We have some Canadians in the house. Love it. I guess I could start popping these up here. We got Florida. Peter saying hi. Riley is from Alabama. Nice. Roll Tide. And then awesome. So let's just, dive right into the slides that I have today. So, again, this is the Dividend Power Hour. It's just, meant to connect with a lot of my followers, answer any of the questions as we have, and also just kind of give you guys an overview on the economy, specific things we want to talk about, and just make this, a fun, interactive hour or whatever it is in terms of time. So if you guys have questions, make sure you smash the like button first, and then just type away. And I'm going to try and get to as many as I can. We've had a ton the last couple of weeks, which has been awesome, and we'll just keep going through them all. Oh, Riley, War Eagle. Okay, awesome. All right, so let's get into this slide deck we got here. Awesome. So in terms of the economic outlook, I always like to kind of give you guys a quick overview on what went on during the week in the economy, as well as specific stocks. So the talk lately has been evolving around this debt ceiling. So both from an investing standpoint as well as a political standpoint. Luckily here we're just going to talk about the investing standpoint. So the U.S. Treasury has come out and said they'll be running out of funds to pay bills, and they will default on their debt by around June 1st. We've had different CEOs such as Jamie Dimon, who's the CEO of J.P. Morgan, said a U.S. default would be catastrophic for the country, as well as the financial sector and the financial markets. Which, if you've been following the banking sector at all, then you probably know that we don't need any more turbulence. Unexpected turbulence to kind of come in with the stock market right now in terms of banks and turmoil. So hopefully that gets figured out here in the next week or two. I know they continue to meet and hash different things out on where one side wants cuts here, and one side wants spending and cuts in a different area. So just really trying to hash that out so that Social Security payments get paid, our debt gets paid, and so on and so forth. Another thing we always like to look at is valuation. This doesn't really change week to week. They're still estimating about $220 in terms of the S&P 500. There's talk of that. I've heard some economists come out and say maybe it's 215. I think we're going to move things out or bring things down to that 215 level if more people get on board and we see an average around 215. But right now the average EPS for the S&P 500 is 220. If we take today's price and do a price to earnings ratio. So that just take the S&P 500 divided by 220. That's going to give you your PE ratio for the entire S&P 500 index, which puts us at 18.8. We looked at last week, if I brought up the same slide, it was at 18.4. So we got a little bit more extended. And on average, as we have seen, the S&P 500 typically trades around 15 to 16 times. In the recent week, we also got an update on CPI. So this is inflation. This has been a hot topic for economists, investors, the Federal Reserve, any of our pocketbooks. I mean, we've all felt it, whether it's going to the grocery store, whether it's going out to a restaurant, whether it's filling up your own gas tank. Here in California, we were back at well above $5 per gallon where I'm from. So the latest readings showed, which was based on April numbers, inflation increased 4.9% year over year. This was the first reading below 5%. We're barely below, but the first reading below 5% in 2 years. We're looking for positives here. And core CPI, which is going to take out your food and energy costs, that grew 5% year over year. So, the banking sector, though, moving over to that is still in turmoil. The sector remains on eggshells. Every single day we're looking at a different regional that's up 20%, down 20%, up 20%, down 40%. So that continues to be, and the debt ceiling really throws in another layer there. So we already have our issues. The Fed continues to increase interest rates, which is going to tighten lending. So that's going to impact things like small businesses trying to get loans to expand their business. That's going to slow down housing segment as well, because they're going to want higher interest rates. They're going to want higher percentage down payments for homes, and that it's just going to tighten up, and that should help with inflation as well. But that's just still a rough sector to be in. There is still some opportunities in there, though, for some high quality stocks. You've seen, I just recently put out a video on 3 that I like in the sector. So definitely check out that video that I put out this week. And then consumer spending, 29% of households earning less than $50,000 are using credit cards. So we're seeing, those credit card balances go up, and those credit card balances aren't necessarily getting paid off, which is a problem there. And that's a continuing trend that we're going to look at closer as we kind of, take a look. Are we going to have a recession? Or are we not going to have a recession? And then tax refunds. So, a lot of the tax refunds have already rolled in or are continuing to roll in, depending on when you filed your taxes. But the average refund this year, this is through the end of April pretty much, was $2,777. That is down 8% from the same period in 2022. So we're seeing consumer spending. Consumers are putting more on their credit cards. We're also seeing the higher income households spend less. But then we're also, tax refunds can, usually can add a little bit more to discretionary spending. But if those are lower now, we're going to expect even less spending from that, jolt of money that you get. So let me know in the comments. I'm just curious. You don't have to tell me the number. Tell me, did you get a tax refund, or did you have to pay this year after you filed your taxes, assuming you have already filed your taxes, unless you did an extension? So we're seeing some other people start to roll in here from Long Island, New York. Awesome. We got some questions. I'll get to some of these stocks that you guys are putting in here. Ventura, nice. Not too far. SoCal, Massachusetts. So we got a lot of East Coast today. Love it. All right. So did we get a refund? Let me know. Did you guys get a refund, or did you have to pay this year? I got a small refund. My goal is always with my tax planning. I have my own business, so there's certain things that I can write off. I work here from home for the most part, but I try and keep everything as close to zero. I don't want to have a big refund, but I also don't want to, I don't want to give free loans to the government, but I also don't want to have a huge payment, which I've had some in the past when I've done, certain rollovers with my retirement planning. But this year was kind of, pretty low key and pretty close to zero. I got a small refund there. So looks like Peter got a refund. Village Carpenter got a refund. Awesome. We got more refunds here. What else? We have paid. Pays okay as long as it's not too much. Again, you want to be really close to that zero is kind of the proper tax planning if you were to ask tax experts out there. So we have folks watching from Brazil. Awesome. Cheers. Thanks for joining. Game On had to pay. John got a refund. Awesome. Eltran paid in, and Matthew got a refund. Awesome. So it's a pretty good mix, actually, to say the least. So let's keep looking here, and let's look at some of the dividend hikes that we've seen recently. These aren't just in the past week; these are pretty much through May, and these aren't all of them. These are just some notable dividend hikes. So we saw Simon Property Group give us about a 3% dividend hike. AIG 12.5%. TSM gave us a 36% dividend hike. We saw a small hike from Apple, which, a 4.4%, and they already pay a small yield. We talked about this in our live show last week. You're not really investing in Apple for the dividend. The growth has been slower than I expected. They have a ton of cash on hand and only give a 4.4%. That was definitely below my expectations. You already have a dividend that's, sitting at 0.6% or below. Tons of cash. I was hoping they would keep right around that 10% average they had been over the past 5 years, but they definitely had different plans. So, maybe they're working on some artificial intelligence stuff, maybe an Apple car. Who knows what they have going on. LEG gave us a 4.6% increase. And then PepsiCo with a nice dividend hike at the beginning of the month. We saw a 10% dividend increase from PepsiCo. So that was a solid one there. Do you guys own, I'm going to go out on a limb here and say you guys probably own Apple, but how many of these 6 that we just mentioned on these dividend hikes do you guys own? I'm going to go out and say, I'm going to say probably average will be 3. Apple, if you guys are dividend investors, PepsiCo probably, and if you guys are some REIT investors, maybe some Simon Property Group. So looking over here at the comments section still, some more refunds. I paid a small amount, $329. That's perfect. You can't really complain about that small of a payment. I think, if you're doing your tax planning looking out over a year and you end up with a $329 payment, I think that, I would be happy with that one way or the other. So is 2023 the year for an IRA Roth conversion due to the looming recession? So yeah, definitely when the market is lower, that's going to be your time. And there's a couple things you want to be careful about here, Matthew, is when you're doing a Roth IRA conversion is number one, how much money do you have in a traditional IRA? Because there's going to be some tax basis that you're going to have to calculate, if you want. But if you have nothing in there and you're doing a backdoor Roth IRA, then that makes things a lot easier. But there's some pro rata rules that you're going to have to look up on when doing a Roth conversion. And then on top of that is the tax consequences. So if you have gains, say you have money in the traditional IRA that you have been accumulating gains, you've had, say you're invested in Apple or different stocks or ETFs, and you have gains in those. Remember, those are pre-tax dollars. So now you're going to need to pay the tax for those dollars, and you're going to have to pay taxes on any gains that you have. So, and the thing you want to be careful about, and again, not trying to give tax advice, make sure you consult a tax professional, whoever that may be for yourself. But you want to be careful. You don't have to do it all at once, but make sure it doesn't bump you up into another tax bracket to where all of your income or a big portion of your income, you're going to be at a higher tax bracket than you assumed, which can really catapult things. But definitely in terms of your question, is this the year? If the market is lower and you're sitting on, some losses and stuff like that, and depending on your situation within the traditional, that could be a good time rather than say, the end of 21, 22 when the market was shooting higher. So good question there. So I'm going to say Margot, LEG, and PEP. Awesome. 2 in ETS for Brian. TSM, Apple, and PepsiCo. Okay, that was going to be, one of my main guesses. I went with SPG as the third one, but that's awesome, Peter. Apple and Pepsi only. Awesome. 4 of these. Wow. That's pretty solid. Village Carpenter is asking about ML or MPLX. Let's take a look at them real quick. So we'll add my screen sharing here. Let's take a look at them. I haven't looked at a MPLX partnership. So kind of been moving sideways over the past year. You could see here, you got that 9.1% dividend yield. Not one I've looked at a ton. Have they put any earnings out recently? Let's take a look at those. Early May, they kind of started here. So GAAP EPS beat, small beat there, and they beat on revenue, net cash. How much are they providing there? Up 14 and 9%. Okay, that's pretty solid there. And they're adjusted. Those are all looking pretty solid there in terms of, what the main focus with them is going to be your adjusted EBITDA. It's great to look at those headliners all the time with GAAP EPS. I like to look at non-GAAP EPS. And then revenues, but you want to kind of peel back the onion a little bit more and look at those adjusted EPS, operating income numbers, look at the operating margins instead of just gross margins when looking at a stock. So me just briefly looking at this, looking at these numbers, these headline numbers, and as well as adjusted EBITDA, it all looks solid. But without me doing any price to earnings or valuation stuff, it's tough to say just because it's not one that I follow all that closely. But in terms of what they just reported, that looks pretty solid on the headliners there. Another, we got folks from Canada. Awesome. Some more. That's like our fourth Canadian there. Awesome. I love it. You are welcome for looking at that. All right, let's keep going on our slide deck here. And let's start talking about a recession. So, would be curious to see what you guys think. Do you think we're going to see a recession here in 2023, end of 23, call it, beginning of 24? Let me know in the comment section there, just what you guys are thinking. Just always curious to see what other investors are thinking in terms of recessions. There's a lot of news out there to try and digest. There's folks that are on both sides of the aisle in terms of soft landing, hard landing, and what the Fed is doing here moving forward. So for those of you that are newer to investing and you're just like, okay, I've heard of this recession term, but how do you really define it? Well, the common rule of thumb is 2 consecutive quarters of negative GDP. So Q1 we saw, I think it was about a 1.1% GDP growth. So we want to see, or we don't want to see it, but in terms of a recession, it's going to be, if Q2 came out and said, oh, GDP was actually down 0.3%. Okay, well, that's one quarter. Then quarter 3 comes out and says we were down 1% growth over the prior year. Then that's going to, that'll be our 2 consecutive quarters where we can call this a recession. Now, it doesn't necessarily have to be that. There's actually a government agency that does all different trends and says for sure or officially now we're in a recession, because when COVID hit, the market just went straight down. It was like, oh, boom, we're in a recession instantly. We didn't wait out 2 full quarters to say that was a recession. And it was a V bottom. We just went straight down and then we fired straight back up. So it was very, when you look at a lot of those charts that have grayed out areas saying this was the time period for recession, this was the one for during the COVID pandemic was super thin. So that's kind of your, what is a recession? That's high level. So other things, signs of a pending recession that we're moving towards it is, lower shipping demands. We've seen that from the likes of, a lot of the shippers from UPS, FedEx, or you can even look at the trains or trucking companies as well. We've seen earnings decline. A lot of the headline news has been around like Q1's actually not been too bad. It's or what they say is it's better than feared, which I hate that term because we've already seen so many economists or analysts slash their estimates. So we're bringing down our estimates a ton, and then we met those. Better than feared. I mean, it is what it is, but I hate that term. They weren't good. However you want to look at it. People are cheering about Apple's stuff here, and frankly, I wrote an article saying that Apple looks overextended. Do I like Apple as a company? Love Apple as a company, but at 30 times earnings, that's not something I'm going to pay and see that it's sustainable. We saw service revenue growth of 5%. That's some very low growth. iPhone sales really bailed them out for the most part, and a lot of that had to do with China reopening. Other areas you look, Mac sales were just down in the basement. So when you again peeling back that onion, not just looking at headline news, revenues were up and iPhone was up. Awesome, Apple did great. You really want to look into it more and then do your valuation calculation. And 30 times multiple on a company that's going to be growing in the low to mid single digits for the next year or two, not something that looks all that intriguing to me. Does that mean the stock's just going to go straight down? No, it could trade sideways. And a lot of the stuff we're going to talk about, this is forward-looking stuff. Remember, the other thing with the stock market is that it looks 6 months out. So when the economy bottoms, the stock market is probably likely already recovering. So we want to see the stock market bottom first, and then the economy is slowly going to follow it in. So earnings decline. We just saw Q1. We're through a good chunk of the Q1 earnings thus far for the S&P 500. Wage growth, that's continuing to slow. We'll take a closer look at that. Unemployment, that's really been the resilient part right now. Unemployment's at about 3.4%, historically low numbers, which is good for those that are out there looking for jobs. Or have jobs, they're able to find them. Retail sales, consumer spending accounts for roughly 70% on average of the economy and GDP. So these are kind of the things you want to look for when earnings are declining, wage growth's coming down. Once you start seeing unemployment start to creep higher, retail sales coming down, folks putting more money on their credit cards, that's when you start to raise a lot of those red flags, those recession red flags. So when is it coming? That's the question I get every single week on social media. It's less about are we going to get a recession, and now more about when are we going to get a recession. I just thought that was interesting here. So, tell me, do you guys think we are going to have a recession in the next, we'll call it 12 months? Let me know in the comments. Margot, absolutely. Yes, there's going to be a recession. Calling a month. I love it. I love the confidence there. So September. So that'll be, kind of after once we get Q2 GDP, Q3 GDP. Those are kind of going to be so we're kind of expecting, or you're expecting, that the next 2 quarters is when we're going to start seeing negative growth. And that's, we only saw 1.1% GDP expansion in Q1. So that's very likely. I would, can't argue with that one at all either. El Tran is asking about, would you give your view on Vici and PayPal? So PayPal is a stock that I owned during the pandemic, made some good money on it and luckily got out. And, but I was also, excited about PayPal. Wherever you go right now, there's a PayPal option, but, the competition is stiff. And that's the problem I see with PayPal. Venmo is an awesome tool that they have, or app, whatever you want to call it, but they don't make a ton of money. I use Venmo, more than Zelle. I probably use Venmo once a week. But they haven't figured out how to monetize that yet. And that's an issue. And then Apple, people love using, Apple Pay, especially, it's not just Apple Pay when you go to the store, but when you buy things online now, there's a Shopify Pay, there's an Amazon Pay, there's an Apple, there's just so much competition now for PayPal that it's really hard to kind of see the growth trajectory for the company. They've been trading at a high multiple, but they've been, getting hit hard lately. So it's way hard if you want to compare it to its highs during the pandemic. Vici, on the other hand, so you're asking about 2 completely different companies. Vici, let's bring them up here on the back here. Let me get out of the way. So we'll bring up the Vici chart. This is my largest REIT holding. So that kind of tells you how much I like Vici. Vici on the year is over the past 12 months is up roughly 17%. They were down 2% today, but largely it's kind of been trading sideways since August of last year. Year to date, the stock is pretty much like I just said, trading sideways, up 0.5%. But in terms of growth, I love Vici. I think we talked about them on the live, the Dividend Power Hour last week, and we've kind of talked about, don't think of it as much as casinos are going to struggle. The actual operators, like if we go into recession, are people going to be running out to go gamble? Well, stats have said actually yes, because people are trying to get their money back quickly, or stress levels are high, so they just want to have a night out. They don't just crater completely all the time. But regardless of that, Vici went through the global pandemic, which we saw REITs, you wanted to focus during that time is, are they getting paid their rent? Because remember, these are landlords. Are they getting paid their rent when all of these companies, these retailers are struggling? Even some grocery stores, as a matter of fact, were struggling. The high quality ones, not as much. But there was all of these companies that were struggling. They had to take breaks on paying their rent, and they had to work out deals with their landlords. Hey, give me 3 months, give me 4 months. Let's rework the deal. Vici collected 100% of their rent all through the pandemic, and they continue to do at this point, because not only do they have great properties, they have great operators. They only work with about less than a dozen different operators, including Caesars, MGM Grand, which they own that, but they also work with the operator for that. So they own the likes of MGM, Caesars Palace, New York, the Venetian. They're the largest single landlord on the Las Vegas Strip, and they get roughly 50%, slightly below, like 46, but they get 46% of their annual base rent, and their exposure comes from Vegas alone. Now, they own properties all over the place. They have, Harrah's properties that are, out in the Laughlin, Nevada area, and other places in Lake Tahoe. They have some stuff out in the East Coast, Midwest. So that they're not just in Vegas, but 46% to 50% of their exposure for annual base rent comes from Vegas alone. So they own some great properties. I love what the Vici management is doing. We're continuing to see some solid growth there. They had solid earnings. If you want to look here at the dividend, you're getting a 4.8% dividend. That's a solid yield that you're getting there, and we're seeing dividend growth from them as well. So they don't have a 5-year dividend growth rate because the stock hasn't been public for that long yet. But we can look here at the dividend history, And you could see how that, it started as a quarterly dividend of 16 cents, and now we're sitting at 39 cents. So it's, they've been growing it each and every year. So for the past 3 to 4 years. So, short answer is yes, I like Vici. It is my largest REIT holding. So that's what I have to say about Vici. So if you guys, again, if you have questions like that and want to know about specific stocks, let me know, and I will just give you my opinion. It's just strictly my opinion. I don't cover all the stocks, but if it's REITs, dividend stocks, I can, I track a lot of them pretty closely. So let's get back to our questions here and our answers. I believe Fabio said, I believe it'll be around the last quarter. So I'm assuming you mean Q4, which, I'd probably agree with that, because Q4 is really when we're going to get the GDP for Q3. So, it's going to have to be around that Q4 timeframe. So, Areli, if I'm saying that right, I think yes. For American Pattern, yes. Dividendology, my friend, thank you for joining. Awesome to see you. Hope you're doing well. We'll have to get you on the stream one time, do some Q&A. If you guys haven't checked out his YouTube channel, definitely check that out. He goes through dividend stocks just like this, but he's got a great valuation presentation that he shows on his videos. So definitely check out Dividendology, my buddy there. Game on. I believe we already had a recession last year. Now we are on a very, very slow, very slow path to recovery. There was a lot of folks that did say that, but we didn't really get that 2 consecutive, which is what a lot of folks are looking for, that 2 consecutive periods of GDP. I spoke a lot about when I was, technically, and when I was doing my newsletter. If you guys subscribe to that, the Dividend Investor's Edge, which is the top newsletter for dividend stocks on Substack, if you read that, then you know that I was talking about that a lot last year, but still believe we're going to get our 2 negative GDP growth timeframes here to get a technical recession here coming forward. Thank you for answering. Yes, you are welcome. Oh, we're getting a call there from Dad calling me during the live. He wanted to join the live group there. What else? IBM. Now that is an old school dividend payer right there. That's, they've actually been turning things around in terms of the company. Remember, when you're investing in the company, not the stock. That's what, Warren Buffett talks about a lot. But let's take a look here at IBM's recent, I know they had a dividend increase. I don't remember the percentage there entirely. So less than 1%. That's kind of to keep the dividend record moving forward. But IBM isn't one I've looked at in a while, so I don't see their earnings, off the top of the head there. So I'll have to get back to you on that one, Village Carpenter. In terms, if you're talking more like technology based, these, technology, computer chip type stuff, Broadcom and Qualcomm are 2. I just bought some more Qualcomm. They dipped a ton in this past week, and Broadcom is just a company with awesome dividend growth. They've had huge dividend growth. They have huge amount of free cash flow. They have an AI component. They have a very diversified, business and products that they have, whether it's, data centers, AI, all these different chips there. So you can see here now, looking at Qualcomm year to date, the stock's only down 3%. But if we looked at over the past month, you could see 16% decline for shares of Qualcomm. They reported their earnings that came out, showed some slowing trends that investors weren't looking for. It wasn't a great quarter. I'm gonna say that, and they're gonna be in a future video here for me. But again, if you are a subscriber to the Dividend Investor's Edge, then you will see that I bought more Qualcomm moving forward here. So it's a long-term play. They have some short-term headwinds that are coming forward. So, or near-term headwinds, but I think in the long term, at this valuation, this is a great stock to take a look at. You're getting a yield of over 3%, which we don't see a ton with Qualcomm. You're not going to get a ton of dividend growth like you're getting with Broadcom. That's one reason I like Broadcom. They're operating at a great point, but also they've given you the dividend growth. Here, 5.6%. If I run over to Broadcom real fast, 25% 5-year dividend growth there. So that is just awesome for them. So Village Carpenter has Qualcomm within, you're using it within a fund, not straight up. Got it. Awesome. So if you guys have more questions, keep popping those in and I will get to them. But right now I'm going to keep going back to our slide deck here. We only have a few slides left. So hang with me there. We're 30 minutes in, so keep the questions coming, and we'll keep moving here on the slide. So for me, a back half recession is likely. I think that Q4 that someone said earlier is proper timing, because likely it would be Q2 GDP and Q3 GDP both coming in negative, which would mean that would come out in Q4. So around that Q3 Q4 timeframe is when I'm expecting. Some of the things that are showing up is, inflation is still stubbornly high. It is down, but 4.9% is not an acceptable rate for the Federal Reserve. They're still trying to get to that 2% rate. Now, would they stretch things and say, okay, maybe we'd be okay with 3%? What their words that they're speaking seem likely that they're really trying to get to that 2%. So we just had another Fed rate hike. A lot of economists and analysts are thinking that we're done. We're going to pause now. There's some that are still expecting a cut. I think that's very optimistic. And I say that people think this is a good thing. Like I mentioned on the live last week, the Fed cutting rates means the economy is not doing well. So you don't necessarily, I don't know why Fed cuts are going to be cheered. Yes, the debt is going to be cheaper. It's going to open up some situations there. But if the consumer spending is down, if demand is down, then companies aren't doing well. So be mindful of that when we're talking, and you're watching on CNBC or wherever you watch your investing news or reading it, that Fed cuts aren't necessarily something to be cheered. So inflation is still stubbornly high. We've had 10 consecutive rate hikes, and we're still at 4.9%. So that is very fast in terms of the number of hikes and the vault, and how quickly we've got to this 5% plus. But something to continue to watch closely. Another thing to look at, that we're going to look at a chart here on the next slide. Trucking stats showed one of the worst declines in this last month, in the month of April, and it was actually one of the worst declines since 1970. And we know that 1970 period, which I discussed in a video and on our live before, that was a period of stagflation, where the economy was just going sideways. It wasn't declining, but unemployment was still high. And we also, it wasn't growing. So something to be mindful of. Economists expect rising unemployment to start in Q4. This has been what's kind of saved the economy thus far, is what they're saying is unemployment is at 3.4%. That's pretty much full employment if you're asking an economist. That has no direction to go really, but up. We're seeing jobless claims continue, first time jobless, initial jobless claims continue to rise over the past few weeks. So it could be a thing of where people lose their jobs and they're not really looking for jobs yet. A lot of that happened during COVID, but during COVID it was completely different, because there was so much government stimulus out there, where there was some folks that were saying, hey, I'm making more money being on unemployment than I would be participating and looking for a job. So the participation rate really dropped a ton. What else we got? So we have consumer spending is starting to slow. Definitely at the higher, we're going to look at a chart there in the next couple of slides also, where it's the higher income households are spending less, which is a major issue, because they account for such a large percentage of consumer spending. And then valuation and multiples remain high, not just the S&P 500 as a whole. We talked about other specific stocks like Apple are trading at a 30 times multiple. When you're trading at a PE ratio of 30 times, if you're trading at a multiple above 20 times, I expect a lot more growth. Average for the S&P 500, if you call, is around 15 to 16 times. So if you're above that, I expect you to be growing EPS much faster. Apple is expected to grow at a single digit, mid to low single digits over the next 2 years. I'm not paying 30 times for that. I own Apple. I haven't sold any Apple, but I'm definitely not buying any Apple. Have you guys, in the comments, let me know, have you guys bought any Apple in this year alone? Let's say that. Have you bought any Apple in 2023? Let me know. Look over here at the questions. Fabio, going back to the Fed there, he thinks the Fed will raise rates another quarter point 2 more times. So 2 more. So that'll be 12 consecutive rate hikes. I don't think the next one is necessarily off the table. There's a lot of folks saying, okay, that was what we just went through. That was done. We're going to pause now. We could have a long extended period of rate pauses, but I'm kind of, with you in terms of the next one, at least. I'll get to the second one once we get there and see. I'm just taking it month by month, looking at the data, but I think we could potentially get one more rate hike. No Apple for Village Carpenter. Okay. Shorting Apple. Gun Blazer. Love the Cowboys logo there as well, even though I'm in California. I'll let you guys in on a little secret. Gun Blazer, I'm shorting Apple also. So I have a small, again, I told you I own a position, so I'm kind of, going both ways. But in the near term, I took out a position to short Apple, very, very small amount. But I typically don't, tell people when I'm shorting. I don't suggest, just because I don't want people to get in the short game. It can be volatile. It can be higher risk or whatnot. Not as much as like doing some crazy options trades or anything like that. But Apple's a tough one to do, but I took out a small short. So, I'm with you there on that one. Just, and I've already kind of mentioned why. Matthew's got some Apple and ETFs. So yeah, if you own the S&P 500, if you own QQQ, you're likely going to own some sort of Apple. Michael, hello. Irelli has, I'm assuming that means Apple as well. All right. Well, let's keep rolling here for the last couple slides, and then we'll keep going to your guys' questions. I'm trying to get as many. They're coming in quick, so I'm trying to get to them and see as many as I can as well. So let me take my screen off there. There we go. So this is an exhibit showing that job losses are increasing since October 2022, and this is looking at the initial jobless claim. So when if you get laid off and you go file for unemployment, that's going to be an initial jobless claim. We've heard, this shouldn't be a surprise, considering since October 22 how many layoffs that we've seen. Especially, it started with the tech sector, but it's gone much further than that. We're seeing it in the likes of Disney, other consumer discretionaries, consumer staples as well. It's not just honed in on the tech sector anymore. It started that way, and that's just due in part because they overhired. They went through this. They had tons of demand that was pulled forward during the pandemic, and they said, we needed to hire this many people. That demand just isn't there anymore. So that's why they're trying to more right size it. That's how I viewed it early on, is saying these tech companies are trying to right size. It also allows them to, cut some of the fat. If there's certain people, no one wants to do layoffs, but there could be opportunities there that, people say, oh, well, this is our opportunity to get rid of this person. If in terms of performance, no one wants to fire someone. So it could be an excuse there, but we're starting to see more initial jobless claims creep higher. It'll go up and down, but you can see the direction and the trend there moving forward. And then the last slide I wanted to show you here was on the trucking. I mentioned trucking is a big indicator, a good way that a lot of people look at for recessions is they track the transportation index. You can follow, there's ETFs that you can follow, because that's going to be the first one usually that's going to be on the downtrend before the recession hits. And you have to think about it. Trucking handles 2/3 of total freight moved each year. If people aren't ordering things, there's no need to ship anything. If companies aren't ordering supplies to create things, there's no reason to ship things. And that's really that first roadblock that people are going to see start moving down south before a recession hits. So, as I just mentioned, trucking handles, it's almost roughly 70% of total freight moved each year. And April, I mentioned it earlier on an earlier slide, was one of the biggest declines since, with two S's, the 1970s. And you can kind of see this chart here of the truck tonnage hits, the tonnage that they carry. You could see the drop there in April to levels that were last seen during the pandemic. So we're already pretty much at where that was, and dropping faster, moving towards where we saw in the late 1990s, we'll call it. So that's something to be concerned about moving forward. Another indicator that we had looked at was consumer spending and spending per household. So credit card spending per household dropped 1.2% in April, which was the first negative reading since February of 2021 per Bank of America. Bank of America also noted that high income household discretionary spending was lower than that of middle and lower income households. So the higher income spent less on household discretionary than middle and lower income households. Very notable there, just due in part that how much the higher income households account for. And you'll see that there, down below, unemployment continues to rise faster too. So some you're starting to see the red flags. And this, I'm not going to be calling for the stock market to drop on a specific day, but my job here and what I try to do on my channel is to give you this high level viewpoint, a different viewpoint for you to consider, to be ready for and to start positioning your portfolio for, because things don't happen just all at once. Things like we saw during the February 2020 and March 2020, when the market was just only going in one direction. Things don't happen that quickly that often. Now that's the most recent. So you might say, hey, Mark, I'm a newer investor. That's all I know. So I understand that, but just something to be mindful of moving forward, that, where the economy is and where the economy is moving. So higher income households spent less in April overall, not even in this consumer discretionary that we just looked at, overall, than they did a year ago. So that was a decline as well. And then another red flag for the higher income jobs is unemployment is rising faster in these higher income jobs. And the highest 40% of households account for over 60% of overall consumer spending. And as we saw in a few slides back, consumer spending accounts for, on average, 70% of GDP. So now we have the higher income households. They're spending less. They're getting laid off. The middle and lower income households are putting a ton of money on their credit cards, not paying those off. Interest rates are going up, and you can kind of see how this is starting to snowball in the wrong direction. If we're, a lot of the savings that everyone was able to save up, oh, I'm working from home, I'm not commuting anymore, I had an hour drive, my gas bill is down. A lot of this money that we saved, people saved a ton of money during the pandemic, gone. That is all gone. And now we are starting to see households put more money on credit cards, not pay them off. Higher interest rates, unemployment is overall is very low right now, but really only has one direction. Jobless claims are rising. You're starting to see the writing on the wall. So that's really all I have for you guys in terms of slides now. I'll definitely start, if you guys do have questions, let's hear them there. So, excuse me. So let's pull up my other screen. There we go. So some of you were asking about Aries Commercial, not one that I, follow all that. It's very less than $450 million market cap, but this one has just been heading in the wrong direction. I was looking at this probably a couple weeks ago because someone had asked about it. But these double-digit massive yields are not something that I get all that excited about. So for me, it's not one I look at all that closely. So, no real opinion on it, not something that I'm going to own in my portfolio, but all right. USB. So US Bank, let's take a look at US Bank. This is a long time, Buffett holding. And if you saw in, what was that? Monday's video, when I talked about financial stocks, Buffett has gotten rid of all of his financial holdings. Every single one of his financial holdings is gone except for one. And that is Bank of America. That's a dividend stock that I own, just to be in full disclosure. Bank of America has a great management team. They have, Brian Moynihan has done a fantastic job there. And the higher interest rates are allowing for higher net interest margin. But in terms, if we're going to look more at the regionals and U.S. banks, they're going to be like a tier 2 big bank. I wouldn't really consider them all that much of a regional bank. So I don't want to put them in that realm. But this is a solid bank, and you're getting a 6.5% yield on U.S. Bank, which is really unprecedented. Definitely one, if you're looking for a smaller bank and you really you're saying, hey, I don't want to be in the big banks, I'm looking for something that has some upside, then U.S. Bank is probably, even though you're going down a tier, it's going to be the higher quality in that tier. So that's all kind of note on that. But again, that 6.5 dividend is quite juicy. You've been getting 10% growth, and they've grown it for 12 consecutive years. So they're well on their way, halfway mark to being a dividend aristocrat. Now, I expect the payout ratio though to continue to creep higher. So definitely, keep an eye on that. The latest reading here, according to, I'm not looking at the financials, is 50%. So, something to keep a closer eye on there moving forward. I wonder if it's a bad idea to invest in human resource stocks. What would be an example of what you consider a human resource stock? So Fabio's asking about UPS in general, and they had a terrible quarter. That's when the red flags really started blinking on the transportation sector, when they mentioned the demand had just dropped off. We've already saw it with FedEx in prior quarters, and their stock got hammered a ton. But yeah, UPS only 4% when you look at it over the past 12 months, but they had some nice increases there in August. But year to date, well, it's only 3%. But the past month is really where the declines have been, similar to that of Qualcomm, down 11%. So you're getting, almost a 3.75 yield on that. Short interest isn't all that bad, but still, a forward PE of 16 times, just depending on what the growth is. That's right around, average S&P 500 there. So let's see what they've been doing with their dividend over the past 13 years, and almost a 13% 5-year dividend growth rate. You're getting a 3.8% dividend yield. Not all that bad there. So UPS is, you want to see it bottom. We're seeing the writing on the wall in terms of demand. So it's not something I'm jumping after right now. So, I'm not a bottom caller. I'm not great at timing the market. It's a tough game to play. So for me, I want to see things turn around before I jump into it. Buy Visa and buy MasterCard. That could be a financial play there. I own Visa. I don't own MasterCard, but I kind of want to just pick one or the other, but I've owned Visa for quite a while. They got things figured out with Amazon, which is nice. That was a kind of a concern, but they've been kicking butt and taking names. They're up almost 18% over the past 12 months. Year to date, the stock's up 11%. Not huge on yield. You're not buying Visa and MasterCard for their yield right now, 0.6, and I think it was 0.7 we saw for Visa. But Visa's a dividend growth stock. When we look here, 17% dividend growth. So that's solid dividend growth, but it's similar story to Apple in terms of the yield. Are you owning Visa particularly for the dividend? Probably not. But the nice thing is, this is something I would like Apple to do. They have tons of cash on hand. Why can't we get a 10% dividend growth rate? They're putting in it stock buybacks. They announced a huge stock buyback. So they pretty much said, we'd rather use our money here. So that's still returning it to shareholders. But so Visa's name I like. Visa's a name I own as well. SCHG. Now, if you would have said D, then I would have really been excited. But the Schwab US, this is just going to be your, what's the expense? Yeah, 0.04. So that's going to be the first thing I'm going to look at. I already know the top holdings in it, but a 0.04%, that's pretty much a free ETF to own. You're going to get, a ton of the S&P 500 exposure. Apple, Microsoft, Amazon, NVIDIA has just been a stock that's been on fire. So, just looking at the top four there, and this is why, doesn't mean I'm not, I'm always looking to invest, but this is one reason why I'm not as high on the S&P 500 in the near term. You have right there, Apple been moving higher at a high rate of speed. Microsoft's been moving higher. NVIDIA has been on fire, stock doubling just this year alone. No one can expect that. You have Meta Platforms, another stock that has doubled. So you have just right there, we just went through a handful of stocks. You have Alphabet, Class A and Class C. So you really need to combine those when you're looking at exposure. That stock's at the highest it's been trading in like a year or two. And, all of this is starting to show, okay, we have high multiples. We have stocks trading at the higher end of their range. What is the catalyst higher? We're already trading at 18 times. What is going to take the stock market higher? We're going to either need multiple expansion with some of these companies, which means we need strong earnings growth. But as we saw, analysts are expecting. Now, they could be wrong. Analysts could be wrong. But NVIDIA is all on the AI craze right now. Meta's on this AI craze as well. United Health is the first non technology. I mean, you call Amazon a technology if you want to consider their cloud, but they're also e-commerce. But United Health is really that bellwether. And then you have Tesla, which is getting their CEO back, Elon, who I don't know if you guys just saw, but he is stepping down from Twitter. They haven't named a new CEO yet that I've seen, but he said there's a woman in line that is going to be taking over the helm, sorry, of Twitter within the next 6 weeks. So Twitter's going to be getting a new CEO, and hopefully Elon can go back to Tesla and trying to get a vehicle that can drive itself here, and also send people to Mars on his rocket ships, all while tweeting on it. And then we have Visa, which we just covered. So low cost, you're getting some, solid exposure there. But that's the only thing I'm going to be mindful of is I'm not looking for a ton of technology exposure right now, just due to those multiples. So long term though, if this is a long term holding, then yes, SCHG is a solid ETF in my eyes. Oh, got it. Yep. A lot of people using their Visa, MasterCard, American Express. The volume's been up there if you saw their recent earnings. So what else we got? SCHD, love it. So you got so you're just a big. Why don't we add some SCHW? If you watch the latest financial video that I did, Charles Schwab is a stock that's trading well below where they should in my eyes, but they've kind of got caught up in all of this madness going on. So the way I'm playing it is I want to buy. I don't own it right now, but I want to buy SCHW. And the way I'm playing it is I've been selling cash secured puts. So I'm selling puts around a $40 strike price, which means I'm collecting a premium. And if it falls below 45, then I have to buy at least 100 shares per contract, however many contracts I sold at the strike price. So if it goes to 44, I need to buy at 45. But if it stays above 45, then I just collect my premium and I don't own the shares. But this is a way that I get into positions that I like. Obviously, I'm not going to buy them if it's a stock that's trading at $500 per share, because you have to buy 100 of those. And if you can do math, that is a high dollar number. So a $47 stock, if I have to buy 100 shares of that, not all that crazy. It's still a high dollar amount, but I like to get in around $3,000 to $5,000 when I'm initially buying into a new position. So definitely like Charles Schwab, what their dividend has done over the past 5 years, growing at a 21% clip. You're getting over a 2% yield now, which usually it's never above 2% for Schwab. But it'll be interesting to see what they do with the dividend growth, just because of the panic that's in the financial sector right now. I don't expect dividend growth moving forward to be at the 21% clip, but maybe they'll surprise us. But then going back to SCHD, since you brought it up, that is under 70. Another one that I've kind of been nibbling at myself. And if you see this, my buddy Brad Thomas here has got the latest. Actually helped him write both of those articles that did quite well. So definitely check those out on Seeking Alpha. So what other questions you guys have in the closing minutes on the Dividend Power Hour? Again, thank you guys for joining today. Hopefully you find these. And if you guys have suggestions on what you want to discuss during, I want this to be interactive. If you like the economic overviews, then, definitely just give me a thumbs up that, keep it as is. But if you have ideas, always open to new ideas. As I mentioned on our first ever Dividend Power Hour, I would like to, get some interviews in here. I saw my buddy Dividendology in here. Maybe I can get him to come join us. Even Brad Thomas is a brilliant mind when it comes to REITs. Maybe do a Q&A session with him, and several other people that we can get on here as well. So would love to hear suggestions. You can reach out to me on social media at dividend_dollar on Twitter or Instagram as well. Joseph, thank you. I appreciate that. We'll pick up some Vici based on your thoughts and analysis. Yeah, I mean, definitely, take a closer look at it, see what you think of the company. But in terms of my portfolio, Vici is my largest, just to be open with you, I'm always trying to be transparent. Vici is my largest REIT holding. So, a lot of folks like Realty Income. I own Realty Income as well, but I like the growth prospects of Vici. We are headed towards a recession, but I think they have great properties and great operators within those properties, which is key. You can have great properties, but if the people that are operating aren't driving demand, and good with the way they efficient and with the way they run the company, then it's not going to work out to where they're going to be able to pay their rent. But that's not the case for Vici thus far. I'm currently selling covered puts on Bank of America. Okay, I like, so it's pretty much the same kind of thing you're doing that I'm doing with SCHW. You're doing with Bank of America. Again, that's a low per share one, so it's not a high capital one that you have to get into. So especially if you're not just because of where the stock is right now, I think that's a very cheap one. I love Bank of America. Maybe that's something I should actually look at doing here. Premiums aren't probably high, so if you are new to options. I teach an options course with my students one-on-one. But if you are new to options, this is a great one that I usually, SoFi is good to look at. Bank of America is good to look at, just to kind of get your feet wet with the idea of selling puts or even covered calls. You want those low per share ones. That's only time per share price actually matters. Making money while waiting to boost my position. So it's a great strategy. Selling cash secured puts in a position that you like at a valuation you like just makes a ton of sense, because you're collecting a premium and you could get the opportunity to buy a stock at a valuation you like. So I tune in for your power hour every time. Love it. All three. You got the hat trick. Truly appreciate your time and effort. Well, thank you. I appreciate, speaking with you guys each and every week. And since we're on that topic, I will be on vacation next week. So I likely will not do the Dividend Power Hour next week. I could postpone and maybe do it on Saturday, but Thursday I will be out of town. So I will miss you guys for a week. So we'll have to catch up on what the economy is doing at a later date there. So Christopher has this question: is it good to have both ETF and individual stocks in a portfolio? I also have 4 REITs, but no individual stocks, just ETFs. It's really going to be based on your strategy. Everyone has their own strategy. Everyone has their own financial goals. Individual stocks are going to bring more risk. If you're owning, let's say, Starbucks or Home Depot or Apple, you are reliant on that company performing well. The overall economy could be doing one thing, but if that specific company isn't executing on their goals, then the results will come down, which means the stock price will likely follow. So there's just going to be more risk. Whereas if you have an ETF, that's widening your diversification to where you have a little bit of Apple, you have a little bit of Starbucks, you have a little bit of Home Depot, a little Union Pacific, a little United Health Group, a little Tesla. So that one does bad, like Disney right now. Disney was down 8% or so today. Well, if you have an ETF, which you own Disney, you're not down 8%. The ETF could actually be higher because the other stocks in it lifted itself a little bit higher as well. So it's a safer way to invest, ETF investing. The only thing with ETFs and index funds you want to be mindful of is the expense ratios. If you look at something like, I haven't looked at ARK in a while, and I'm assuming they have not changed their their high, crazy expense ratios of 0.75%. That's really going to eat into total returns, especially for an ETF that has performed as poorly as they have. So over the past year, you're paying 0.75. So you're paying 75 basis points of whatever you have invested in this ETF for a 5% return. You could have went out and found a high yield savings account that for free that pays you interest back rather than paying 0.75% for a 5% return. I know they did well during the pandemic, but that's showing me one time. They've done well one time, and it was primarily because of Tesla. So I just don't like high expense ratios, and that's just me. Individual stocks. So yeah, going back to that, it's really your time. How hands-on do you want to be? Individual stocks are a lot more hands-on. You're gonna have to keep up with the earnings reports. And if things change, you want to have a reason on why you own a stock, so that if that ever comes up to where Apple is now a gasoline company or something like that, you're like, oh, I didn't buy them because of that. I bought them because of their iPhone. They were going into artificial intelligence and stuff like that. And things all of a sudden change, new leadership comes in, then you need to assess why you own that specific stock. So it's a lot more hands-on. I also own 4 REITs. I'd be curious to know what 4 REITs you own. I love talking about REITs. Roughly 20% of my entire portfolio is dedicated to REITs. So that's a sector I like, a sector that's been crushed and has a ton of opportunity right now. Going back to Fabio, my largest REIT is Realty Income, but I picked up shares of WP Carey yesterday, and we've done videos, we've talked about it on the live. WP Carey's got a lot of exciting things going. They really started off with a big presence in office, but luckily, even prior to the pandemic, they were already starting to transform. They had a management arm to them, which they've slowly closed down as well. And they're really now an industrial and warehouse REIT first, which is an area that I'm super excited about just because of where the growth and trajectory is long term. Not right now, or if we're headed towards a recession, there's not going to be a ton of e-commerce sales, but where the trajectory is of e-commerce sales, which account for only roughly less than 15% of total retail sales right now. A lot of different companies, trying to get more into that and find ways. And we need places to store it. So we need warehouses. We need industrial. One reason I like WP Carey, one reason I like Stag Industrial, and one reason that I like Prologis. And Prologis would probably be the top one of those three. Mac M, what about Cat? So Caterpillar, that is the first stock that I have ever owned. Jumping into it as a young kid, didn't really understand everything about it. Didn't understand like, oh, let's build out a base first, stability with the ETFs. S&P 500. I was like, oh, let's just go for Caterpillar. I love the big machinery and all the construction's always going to be needed, but it is a cyclical company. So Caterpillar is not a name I own. I actually own, if you're curious at all, John Deere, and more excited about where they're going with the self-driving tractors. I call them the Tesla of the agriculture sector. But Caterpillar and Deere alike are going to benefit with a lot of the construction investments that the government is making with all the roads, bridges, and highways and everything. So there's going to be some tailwinds for these companies, but this is a cyclical company. So based on how the economy is going is going to be dependent on how these companies perform. But with Deere though, you also have the agriculture component, which people need food all the time. We don't necessarily need to build that road today. We don't need to build or fix that bridge today, but we do need to grow grain and corn and bread or whatever. You don't grow bread, but you guys get the gist of it. What else we got here? Yes, depending on the account that you are holding it in. SCHD Stan is in the love it. SCHD Stan. How many shares are you up to now? I've been kind of following everything with your story and trying to rack up SCHD. And the other question I have for you is, what percentage of your portfolio is SCHD now? I'm a big fan of SCHD, but I don't know if there's a bigger fan than SCHD Stan. You can follow him on Twitter. But his question is, hey, Mark, I've had Vici for a while. My average cost is $25 and change, somewhere around there, which we just looked at a second ago, almost $32. Okay. I find it hard to add to the position with it being in at 32 range right now. Any thoughts as a holder of the stock? What price do you like? So let me pull up something for you guys real quick. Had this up before. You guys know my email. So this is fast graphs. You guys, if you've watched any of my videos, then I utilize fast graphs a ton. It's great for looking at valuations, and you can all the different stuff. You could put in REITs, you could put in individual stocks. You can look at adjusted earnings, which is going to be the non-GAAP. So if I'm not looking at REITs, I'm going to use the adjusted earnings one. And if I am looking at REITs, then I'm going to look down here at the FFO and AFFO one. So if I'm using Seeking Alpha, you're not going to get a ton of the data. It's not going to be right half the time in terms of FFO and AFFO, which is why I do like fast graphs. So let's type in Vici here. So the great thing about Vici is that you always have this blue line here, which is going to tell you that's where the average earnings multiple is. You could see though that analysts are still recession. Everyone knows this is the most widely seen foreseen recession coming. Analysts are still expecting 10% growth for Vici, and ways Vici gets is they have escalators that are written into their leases. They have acquisitions that are coming online, and then they expect 4% and 3% in the following. So with Vici right now, we are trading at, we'll call it 32, and they're looking for 213. So we're trading at 15 times AFFO for 2023. So 15 times. And the blue one that you can see over here to the side, hopefully, let me take down. Let's share now. Share this tab instead. Boom, there you guys go. So this is fast graphs. And the blue line here is going to be your 5-year average. So that's going to be your 5-year average. You can see the 10% growth here down at the bottom, 4% for the following year. So the stock's trading slightly below. The average over here over the past 5 years has been 16.2. So this tells me that they're, compared to their 5-year average, we're trading at 15 times compared to a 5-year average of 16 times. So on the face right there, it looks pretty solid. For Vici, though, when we've got down here to below 15, that's really when it's entered big time value perspective. Knowing that we're going towards a recession, I kind of see where you're going. It doesn't sound like you want to add at this level, if I'm not mistaken, Stan. And I can understand why. But it is a newer REIT, so it's still going through a lot of these growing in terms of valuation. What's a true 5-year average? Do people understand the REIT? And I think it should be trading closer to a 17 times multiple. That's just me, based on the properties that they have, based on the growth that they have. These huge master leases, long-term leases, very safe. They partner with the largest operators, casino operators in the world, really. So I see no issue if you want to nibble here. You have some good gains in here, but if I do see that dip below 15 times, that's when I'm really starting to see. We're right on the cusp right now, where you can call it maybe a buy, maybe fair value, in my opinion. But Vici long term, I think there's plenty of room for multiple expansion, but that. Knowing that we are headed towards a recession, I think we could see, and if we do get another rate hike, you could see some more pressure on REITs, which I'll start scooping up some more of the high quality Vici and Realty Income, just to name a few. So hopefully that answers your question. So you could see here up to 1,076 shares. That is just amazing there. So awesome. Hello, Doug. I made a mistake buying MPW. There's always going to be mistakes. I've made plenty of mistakes in my investing. But the thing I want you to take away here, and this will be our last one, is never invest in yield alone. That'll get people in trouble. And a lot of the questions I get are these high yield stocks or business development companies. It could be anything, or even REITs. Is you want to look more than just the yield. A lot of people love like JEPI right now. But understand why the yield is high. There's limited upside. In the near term, it could be solid, but when the stock market gets moving closer, you are limiting your upside than if you were to buy an S&P 500 ETF or individual stocks that are high in terms of exposure. So never buy and peel back the onion. MPW with their largest operator. I used to own MPW, for full disclosure. Luckily got out before things got too bad. I think I made a small profit, but I just didn't like the lack of giving us information. I felt like they were always holding something back. And when I have an issue with management, that's usually a red flag for me to get out of that particular stock. So that's kind of my take on MPW. Christopher following up, my REITs are Getty O, AMT, and Stag. Awesome. Another Stag fan there. Okay. Awesome. Glad that answered your question there, Stan. And thanks again for popping in. So that kind of wraps up our Dividend Power Hour, which went an hour and 8 minutes. Thank you guys for joining. As always, make sure you subscribe to my channel so that you're notified anytime we have these lives or a new video come out. Make sure you hit that like button. I really appreciate all of you stopping by today, and it was very interactive. And again, I won't be here next Thursday. We'll try and see if we can schedule something on Saturday. Otherwise, I will see you guys in the following Thursday. So make sure you guys have a great week. Happy Mother's Day to all the mothers out there, and have a great night. Take care.